Okay, guys, we're almost at that point where you are ready to pull the trigger. But I want to go through a couple of more things. I want to explain the differences between ETFs, mutual funds, and index funds in a little bit more detail, and why it might be most advantageous for the majority of you to go towards an ETF. So let's start here with the basics before we get any further. Mutual funds, what are they? You hear about them all the time. Mutual funds are actively managed funds that people put a bunch of stocks into. 87% of these do not beat the market. The goal of a mutual fund is for you to beat the market, but 87% do not. And why is that? Because they have that active management. So what does that mean? Well, of late, today is July 25th of 2023, and AI is the big thing, and NVIDIA is the big thing. And when we see NVIDIA going up 160% in the year to date, so for the last 7 months, they have to be in that. They absolutely have to be in that. When we see Amazon start going crazy, we have to be in that. And that is why they chase. And they charge high expense ratios. I'm going to go into expense ratios a little bit more, but their expense ratio is about 50 basis points. And that might not sound like a lot, but you'll find out over time, and the more money that you put into it, 50 basis points is a ridiculous amount of money for something that's trying to beat the market and often doesn't achieve that. So the next one is index funds. Index funds are a little bit better. Their goal is to track an index. Index could be S&P 500. It could be the Vanguard. It can be the NASDAQ 100. These are a little bit better. They're passively managed, meaning that there's no jumping in and out. They're basically just tracking the index. They have a very low expense ratio of basically 6 basis points. So those types of plays are a little bit smarter in my opinion. Now, I want to go one quick thing back to mutual funds. With mutual funds and the difference between those and index funds and ETFs, they can only be traded at the end of the day. So let's say that you're going to trade a stock, let's say Apple, and let's say it's at $100, and right now it's 12:06 in the afternoon. If I go and execute a trade on Apple right now, I'm going to get it at $100. If you are looking at a mutual fund, you execute a trade now, it's not going to process until the end of the day, 4 p.m. Eastern time, at whatever the price is. So it can't be traded in and out throughout the day. It's only at the end of the market day. Now, the last one, ETFs, which are my personal favorite and something that I used to be 100% in, and something that Paul used to be 100% invested in. ETFs are what they are is exchange traded funds. Now, what does that mean? And what is the goal? It means it's a compilation of a lot of stocks. And I'm going to use the SPY, the S&P 500 as an example. So SPY is all 500 stocks in the S&P 500 put together. Now, why is that beneficial? Well, when you have NVIDIA go up one day 30% like it did recently, you would say, well, I wish I could be an NVIDIA stock. Well, if you buy the S&P 500, you are going to be an NVIDIA stock. You are going to catch some of that. Now, on that same day, another stock might come down 10%. It negates risk. That's what it does. So you're not catching that big down 10% day as if you were an individual stock, but the downside is that 30%, you didn't catch all of it. It kind of weighs things out. And that's why when we talk about the benchmark index, it's the S&P 500 or SPY, and it has gained historically 9.9% over the last 100 years, annualized. And that is why those are so great, because you could just track the market. Stock market goes down, don't worry about it. Stock market goes up, don't worry about it. You're going to be on this average line going over a long period of time, and you're going to meet the market. You're going to match the market. Now, there's different types of funds that you can go into, and I'm going to pull up my screen right here. You have 11 market sectors, and I don't want to get too confusing here, but the stock market is made up of all of these stocks, and they're categorized into different sectors. And you can see here, there's real estate, healthcare, finance, energy, utilities, consumer staples, consumer discretionary, industrials, information technology, tech, financial services, and energy. So if you want to go, this is one of my favorite ETFs. It's JETS, JETS. It's a compilation of all the airlines. So it has United in there. It has Alaska Air. It has Spirit. It has Delta. It has American Airlines. As those stocks move up, down, sideways, whatever, you're kind of catching all of it. So you don't have to go in and say, you know what, I'm going to buy American Airlines and I'm going to put all my eggs in one basket that American Airlines does really well. No, maybe you're just going to go and buy the entire, I'm going to call it sector or group of stocks, and they move up, they move down, but they all kind of balance each other out. So if American Airlines goes up 10% one day and United Airlines goes down 10% one day, well, you're neutral and you don't have to worry about the big swing of either stock. And that's kind of the great thing about ETFs. Now, I want to caution everybody. There are sheep hidden in wolves' clothing. And to me, that is an ETF like ARK Innovation, Cathie Wood's fund. Just because there is a compilation of stocks doesn't mean that it's necessarily a good ETF. So you need to make sure that when you're looking at some of these ETFs, yes, hers is quote unquote innovation. Well, 17 out of her top 20 companies, as the last time I looked, lose money. Yes, technically it is an ETF. It's a group of stocks that move together, but I don't see any risk being negated there. When an ETF gains or loses 5 to 10% in a day, that is not an ETF. And you're going to say, yes, well, the stock market can do that. Yes, the stock market can do that, but those ones do it a lot more frequently. I've seen days where her ETF is down 12%. That is not an ETF. That is not something that you want to invest your money, your hard-earned money, your family's money in long-term. If you want to play in that with maybe 5-10% of your money, go for it. But don't think that everything is an ETF. Make sure you look at the holdings that are in there. And the expense ratios are great on ETFs. They're 9 basis points. It's really, really nothing. And you're going to replicate the index. Something that people talk to us about are REITs, real estate investment trusts. Now, what is that? It is basically companies that finance different real estate deals around the country. And you can go and buy these things like stocks. There's certain REITs out there that you can go and buy. So if you're not a person that is directly invested in real estate, or you can't go buy an apartment building or buy a bunch of single family homes or whatever, that is a way that you could diversify and get involved with real estate. I personally have never done it. I don't do it, but I have actual real estate that I invest in. So if you're somebody that's looking for that diversification, you want to be in real estate and you don't want to do necessarily the heavy lifting of property management and rehab and this and that, this could be a good option for you. But make sure you don't just go in there and say, I'm diversifying into real estate. Make sure you understand what's in the REIT, understand what is going on, understand what's happening in the world of real estate. Don't just blindly go in there and say, I am going to diversify into real estate. Now, going back to the expense ratios, this is something where if you've watched anything about retirement and what a little bit of a percentage here and there, or a couple dollars here and there can change over a long period of time because of compounding interest, you'll know that expense ratios, even 40 more basis points over 50 years, can make a drastic difference. So I would caution you to, when you're looking at different ETFs, go and make sure that the cost basis is less than 10 basis points. So for example, you're going to go and you're going to look at the cost basis of the SPY and it's 0.09. That is a fantastic cost basis. You don't have to worry that that is going to make detrimental effects to your returns over a long period of time, versus a mutual fund where the average is 47 basis points. And if we look at the more actively managed ones, it's actually around 68 to 70 basis points. So they're almost taking 1% to manage your money. And often they're not beating the market. The other guys are taking 0.09% to manage your money. Actually, you're really just putting it into the market. And nobody's really managing it. And that you're still matching the market. So I would caution you to make sure that when you're looking at investing in any fund, including the REITs, make sure that you have a low expense ratio. And the great thing about, I'm going to even say mutual funds, ETFs, whatever, it's a conglomeration of stocks. Stocks are going to go up, stocks are going to go down, especially over decades and decades. You need to dollar cost average in. Now, what does that mean? It means, and I'm going to use the example that I use, on the first of every month, maybe you get your paycheck on the first of every month, automatically take out a certain number of dollar amount. Let's say it's $100. Take $100 and put it into the stock market, or put it into an account that's going to go into the stock market. Maybe every 2 weeks do that. $100 in to the stock market. Whether the stock market is way up here or way down here, whether you are buying at the peak of the tech bubble or you are buying at the base of COVID, you're continuing to buy every month, every 2 weeks, every quarter, whatever you decide to do, just do it consistently. In life and in the stock market, sometimes you're going to be the bug, sometimes you're going to be the windshield. Sometimes you're going to overpay, sometimes you're going to underpay. But what's going to happen over a long period of time? You're going to go right on that line. The stock market's going to go like this. It's just going to go up and down, and you're going to consistently grow right on that line. All right, guys. Well, you have gotten to the point where you kind of know the basics. And now what's the next step? Let's go and buy our first stock together. Let's set up our brokerage account. It's a question that we get all the time. Let's go and set up the brokerage account, and let's get it ready for you to make that first purchase. Here we go.